Hello students and welcome to Finance for Engineer course. In last lecture we have discussed about the long-term sources of funds from where the firm can raise funds for financing its various important activities for the growth of the business, for developing various activities in the business. So there we discussed about the two types of shares which company normally issue for raising long-term funds. First is equity shares and second is preference shares. In equity share, we have seen that equity share gives the ownership right to the shareholders and they can vote in the meetings of the organization and can elect their representative in the management. They have residual claim on income and on asset. Then we discussed about the preference shares. Preference shares are the shares which gives the preferential right to the shareholders. They can claim on asset before the equity shareholders, but these preference shareholders don't have any voting rights. There are different types of preference shares. So let us start with the types of preference shares. First is cumulative preference shares. Second, non-cumulative preference shares. Third, redeemable preference shares. Fourth, irredeemable preference shares. Fifth, participating preference shares. Next, non-participating preference shares. Seventh, convertible preference shares. And eighth, non-convertible preference shares. So let us see one by one. First here is cumulative preference shares. Cumulative preference shares have right to claim dividend for those years which have no profit. If the company is unable to earn profit in any one or more years, cumulative preference shares are unable to get any dividend, but they have right to get the comparative dividend for the previous year if the company earns profit. That means the dividend of last year get accumulated and in the next year whenever the company earns profit, the company has to pay dividend, accumulated dividend to the type of preference share. Next type is non-cumulative preference shares. Non-cumulative preference shares have no right to enjoy the above mentioned benefit. They are eligible to get only dividend if the company earns profit during the year. Otherwise, they cannot claim any dividend. Next is redeemable preference shares. When the preference shares have a fixed maturity period, it becomes redeemable preference shares. It can be redeemable during the lifetime of the company. The Company Act has provided certain restrictions on the return on these type of preference shares. Fourth is irredeemable preference share. Irredeemable preference share can be redeemed only when company goes for liquidation. There is no fixed maturity period for such kind of preference shares. Next is participating preference shares. Participating preference shareholders have right to participate in extra profits after distributing the equity shareholders. Next is non-participating preference shares. Non-participating preference shareholders are not having any right to participate in extra profit after distributing to equity shareholders. Only fixed rate of dividend is payable to these type of shareholders. Next is convertible preference share. Convertible preference shareholders have a right to convert their holding into equity shares after a specific period, but the Articles of Association must authorize the right of conversion. Finally, at the end, non convertible preference shares. These shares cannot be converted into equity share from preference shares. So these are the 8 important types of preference share as per the need requirement of the fund and looking at the situation and the business environment. Organization decides which type of preference share to issue in a market. Let us see the difference between equity shares and preference shares. First is definition. Equity share is the foundation of the company as it raises funds. These cannot be converted to preference shares, while preference shares are the shares that promises the holder a preference over the equity share. These can be converted to equity shares. Next difference is dividend. Equity shares do not have right to receive dividend under preference shares based on time, cumulative or non-cumulative, are entitled for the dividend. Rate of dividend. The rate of dividend in case of equity shares is fluctuating, while the rate of dividend for preference shares is fixed. Voting rights. Voting rights under general or members meeting is there or is available to equity shareholders, while preference shareholders do not have any voting rights as such. They enjoy voting rights only on such matters which directly affect the interest of preference shareholders. Types of shares. These are considered as ordinary shares and therefore equity shares do not have any types in specific. In case of preference shares, there are various types like convertible, non-convertible, cumulative, non-cumulative, redeemable, irredeemable, etc. Liquidation. During liquidation, the equity shareholders will have a residual right over the assets even after the repayment to preference shares of the company. The preference shareholders will have first right after the repayment of debts. Participation rights. Equity shareholders are primarily responsible for the management of the company, while preference shareholders do not have any participation right as such in the company's management. So these are certain important points which differentiate equity shares from the preference shares. Now, let us move ahead. This is the debenture, which is again a very important source of finance for the organization. A debenture is a document that is issued by the company. It is a certificate that is issued by the company under its seal, acknowledging a debt. That means it is a written acknowledgement of money borrowed. It specifies the terms and conditions such as rate of interest, time repayment, security offered, etc. According to Companies Act 1956, debenture includes debenture stock, bonds, and any other securities of a company, whether constituting a charge of the asset of the company or not. Next is whenever a company wants to borrow a large amount of fund for a long but fixed period, it can borrow from the general public by issuing loan certificates that are called as debentures. These are offered to the public to subscribe in the same manner as it is done in case of shares, but it is issued to the public as a contract of repayment of money borrowed from them. These debentures are for a fixed period and a fixed interest rate that can be payable yearly or half yearly. These debentures are actually the most common way for large companies to borrow money, and the purchasers of the debenture are known as debenture holders. Next is there are certain features of debentures. So let us see one by one. First is maturity period. Debentures consist of long-term fixed maturity period. Normally, it consists of 10 to 20 years maturity period and are repayable at the end of the maturity period. Next is residual claim on income. Debenture holders are eligible to get fixed rate of interest at every end of accounting period. Therefore, debenture holders have priority of claim on income of the company over equity and preference shareholders. Next is residual claim on assets. Debenture holders have priority of claim on assets of the company over equity and preference shareholders. The debenture holders may have either a specific charge on the asset or floating charge on the asset of the company. Now, what is the meaning of the specific floating charge? Specific charge of debenture holders are treated as secured creditors, and floating charge of debenture holders are called as unsecured creditors. Next is no voting rights. Debenture holders are considered as creditors of the company, hence, they do not have any voting right. Debenture holders cannot have the control over the performance of the business concern. Next is fixed rate of interest. Debentures yield fixed rate of interest till the maturity period. Hence, the business will not affect the yield of the debenture. Now, the next is advantages. First is long-term sources. Debenture is one of the long-term sources of finance to the company. Generally, The maturity period is longer than the other sources of finance. Second is fixed rate of interest. Fixed rate of interest is able to debenture holders. Hence, it is most suitable for the companies who are earning higher profits and compared to other forms of lending, debenture tend to be cheaper. Next is trade on equity. A company can trade on equity by mixing debentures in its capital structure and thereby increase its earning per share. Also, company can get its required funds without diluting equity. Since debentures are a form of debt, the equity of the company remains unchanged. When the company applies the trade on equity concept, cost of capital will reduce and the value of the company will increase. Next is income tax deduction. Interest payable to debentures can be deducted from the total profit of the company. So it helps to reduce the tax burden of the company. Next is protection. Various provisions of the debenture trust deed and the guidelines issued by the SEBI protect the interest of debenture holders. So these are the various advantages of the issue of debentures to the general public. Next is disadvantage. First, fixed rate of interest. Debenture consists of fixed rate of interest payable to securities. Even though the company is unable to earn profit, they have to pay the fixed rate of interest to debenture holders. Hence, it is not suitable to those companies whose earnings fluctuate continuously. During a depression, when profits are declining, debentures can prove to be very expensive due to their fixed interest rate. Next is no voting rights. Debenture holders do not have any voting rights, hence, they cannot have the control over the management of the company. Next, creditors of the company. Debenture holders are merely creditors and not the owners of the company. They do not have any claim in the surplus profit of the company. Next is high risk. Every additional issue of debentures becomes more risky and costly on account of higher expectations of debenture holders. This enhances the financial risk and the cost of capital. Next is restrictions of further issues. The company cannot raise further finance to debentures as the debentures are under the part of security of the asset already mortgaged to the debenture holders. Next is redemption of debentures. At the time of redemption of debenture, there is a significant cash outflow for the company which can imbalance its liquidity. So these are various disadvantages the firm has to consider before going for issue of debentures. Let us see the types of debentures. Firm can issue various types of debentures as per their need requirement. So first here is unsecured debenture, second is secured debenture, third redeemable debenture, then fourth irredeemable debenture, fifth convertible debenture, and sixth other types are also there through which the company issues debenture. So let us see one by one. First is unsecured debentures. Unsecured debentures are not given any security on assets of the company. It is also called simple or naked debenture. This type of debenture is traded as unsecured creditors at the time of winding up of the company. Next is secured debentures. Secured debentures are given security on assets of the company. It is also called as mortgaged debentures because these debentures are given against any mortgage of the assets of the company. Next is redeemable debentures. These debentures are to be redeemed on the expiry of a certain period. The interest is paid periodically and the initial investment is returned after the fixed maturity period. Next is irredeemable debentures. These kind of debentures cannot be redeemable during the lifetime of the business concern. These debentures do not have any maturity period. Next is convertible debentures. Convertible debentures are the debentures whose holder have the option to get them converted wholly or partly into shares. These debentures are usually converted into equity share. Next is other types. Debentures can also be classified into the following types. Some of the common types of the debentures are collateral debentures, guaranteed debentures, first debenture, zero coupon bond, zero interest bond, or debenture. So, as per the requirement, firm can issue any type of debenture. Next is retained earnings. Like an individual, companies also set aside a part of their profit to meet future requirements of capital. The portion of the profit which is not distributed among the shareholders but is retained and is used in business is called as retained earnings or plowing back of profit. As per Indian Companies Act, companies are required to transfer a part of their profits in reserves. The amount so kept in reserve may be used to buy fixed assets. Therefore, this is also called as internal financing. That means a company generally does not distribute all its earnings among the shareholders as dividends. A portion of the net earnings may be retained in the business for use in the future. This is known as retained earnings. This is a source of internal financing or self financing. The profit thus available for flowing back in an organization depends on many factors like net profit, dividend policy, and the age of the organization. Uh, Next is features of retained earnings. First is cost of financing. It is the general belief that retained earnings have no cost to the company. Second, flotation cost. Unlike other sources of financing, the use of retained earnings helps to avoid issue related costs like control. Use of these retained earnings avoids the possibility of change or dilution of the control of existing shareholders that results from issue of new shares or new issues. Next is legal formalities. Use of retained earnings does not require compliance of any legal formalities. It just requires a resolution to be passed in the annual general meeting of the company. Next is advantages of retained earnings. First is cheap source of finance. The use of retained earnings does not involve any acquisition cost. The company has no obligation to pay anything in respect of retained earnings. It is flexible. Management have control over how they are reinvested and what proportion is kept rather than paid as a dividend. Next is financial stability can be assured with the help of these retained earnings. Retained earnings strengthen the financial position of a business and thus assures the financial stability to the business. Stable dividend. Shareholders may get stable dividend even if the company does not earn enough profit. Finally, market value. Retained earnings help to strengthen the financial position of the company and thus appreciate the capital, which ultimately increases the market value of shares. Next is there are certain disadvantages. First is improper utilization of funds. If the purpose for utilization of retained earnings is not clearly stated or mentioned, it may lead to careless spending or utilization of these funds. Next is overcapitalization. Conservative dividend policy leads to huge accumulation of retained earnings and that leads to overcapitalization. And the third one is lower rate of dividend. Retained earnings do not allow shareholders to enjoy full benefit of the actual earnings of the company. And this may create not only the dissatisfaction among the shareholder, but also it adversely affect on the market value of shares. So students, here I'm ending my session and in next lecture we will continue with the other long-term sources of financing available to the business organization. Thank you.